So all good. That's working. Cool. Thanks, Mike. All right, guys. Well, welcome to this webinar. Again, before we start, I promise to try and keep this under 2 hours, so I don't keep you guys all day, and myself too all night. So yeah, welcome. It's been a little while since I did a webinar. Today, we're going to dig into risk management. It can be your best friend or it can destroy you like your most formidable foe would. So you got to really make it your friend. Truthfully, that's kind of what it's all about in day trading. So let's dig in and let's see what we can learn about risk management today. So first, the disclaimer, as I'm sure a lot of you have seen already, nobody here is licensed to tell you what to do with your money. And those guys who are, in my opinion, well, be careful with them too. They're just looking for a commission most of the time. So anyways, it's your money. Be smart about it. You know what to do. All good. Again, my background, same old thing as last time. That still is the best picture of me. I haven't had a photo shoot in a while, so that stays. Yeah, born in Sri Lanka, grew up in Dubai, spent most of my life in the United States, about 20 years or so. Came back to Dubai recently, a couple of years ago. I was a pilot for a while, flight instructor, did most of my flying in Florida and San Francisco. And bounced around a bit with family business, some digital marketing stuff, Facebook ads and all at the time. And it's only really in 2017 that I got involved with the financial markets, and that was always more the contrarian investing sort of thing. And then I wanted to figure out how to make an income out of the market rather than just put my money in there and forget about it for 5 years. So I discovered Andrew's book in 2019 and been with BBT since and been day trading and now doing a lot of mentoring and moderating as well. Outside of trading, I have a bunch of hobbies, mostly water sports and extreme sports and some oddball stuff like I like to play cricket. I like to spend time playing guitar and writing music. Still like to fly airplanes whenever I get a chance. And the most important thing to me is to spend time with my couple of kids. So again, I always like to say day trading gives me that opportunity. And that's the beauty of it. When you figure it out, it gives you lots of time freedom and financial freedom. So you can actually do the things you want to do while you have the energy to do it while you're alive. So, hey, it's good fun. Try and figure it out. Day trading is great. And just like last time, if you've connected with me at all, you would know that I talk about this a fair bit, the 80-20 principle. Anyways, for those of you who haven't heard of it, it's quite simple. There are a few very impactful activities that bring the majority of your results. And there are a lot of activities that a lot of us get caught up and then don't give us a lot of results. But 80% of our effort goes into that. It's quite trivial. So the point is really to try and identify the most impactful things that bring those results that take not a massive amount of effort. The 80-20 thing, 20% of your effort brings 80% of your results. And so I live by this. I think it makes perfect sense. It's a Pareto principle. There are books on this. This is the book on it, Richard Koch. Great book, easy to read. Definitely pick it up, and probably the best book I've ever read. And so, I use it all the time in everything I do, in the way I conduct myself and whatever I do. And specifically in day trading, I found it to be tremendously valuable, the 80-20 principle. You can find what works, double down on that, and try to ignore the rest. It just takes up a lot of your time and energy and causes confusion. And just to kind of reiterate the same principle, again, just look in the world around you, you'll find the 80-20 principle at play a lot, a hell of a lot, actually. Just some examples here where you'll find, 80% of your success comes from 20% of your ideas, or 80% of the wealth is owned by 20% of the world's population, or 20% of the Earth's inhabitants cause 80% of the world's problems. I mean, just look around you and what you know of the world and your experience, and you'll find that this is really always at play. It's quite shocking, so it makes sense. And the truth is, once again, it's important to figure out what are those 20% of most impactful activities and where you should put your time and energy and effort to bring the majority of the results you're trying to get. That's the whole idea. Just double down on doing more of what works and less of what doesn't. So yeah, I hope that makes sense, and I hope I haven't lost anyone just yet with this. And here we go, risk management. Now, in day trading, if anybody was to ask me what is the 80-20 of day trading, the singular 1-80-20 thing, risk management is the word that comes to my mind right away. Seriously, it just pops into my head right away. Because the truth is right here, manage your risk and the profits will take care of themselves. This is a tweet that Andrew put out at some point last year. I couldn't find it when I was making these slides, but he put it out there and it kind of stuck with me. And it makes sense to me. Listen, you just manage your risk. It's the name of this business is risk management. And really, that should be what we think about all the time. Because we're getting into the market, we're looking at setups, we're waiting for ideal setups. And then when we put the risk on, we still don't know if it's going to work out or not. The truth is we never know what the market's going to do, no matter how fantastic the setup looks. So it's important to manage your risk, even in those A+ setups, because there's a possibility it's not going to go in your favor and you're going to stop out. As compared to if you just hold it, believing that the setup is so good and it's going to go, but you're holding and it goes against you and end up holding it overnight. And, I've seen examples of people doing that, and it's a mess. That's how you blow everything up. So in day trading or any kind of short-term trading, actually even in investing, risk management is the centerpiece of it all. It really is so critical. And I'm going to try and break it down for you in some of those elements of risk management, especially some that we don't talk about often enough. So let's dig in a bit more. So really, one of the ones that we don't talk about enough, I believe, is the person before you start trading. When you come to trade, you should have a clear head. You should be emotionally stable, again, as compared to emotionally volatile. That's you, the human being. Now, and the way I like to say it is people don't have trading problems. People have life problems that reflect in their trading. So they've got all kinds of stuff. We have all kinds of stuff in our lives. We got trouble with a divorce or the mortgage or debts or, all kinds of stuff. And the world is full of stuff that brings us trouble. And the truth is, if we are struggling and suffering because of all that stuff, we're not fit to trade. We're already in an emotionally kind of vulnerable state. And therefore, you can't be trading. You got to evaluate yourself before you show up to trade. And you got to make sure that you're stable enough for trading. Ideally, you're at, peak mental and emotional strength. That doesn't mean that, you can only trade when everything is absolutely perfect in your life. That's not what I'm saying here. What I'm saying here is, as things in this world hit us and we struggle with them, well, if it's really, getting under our skin, that's when we don't trade. If we got things kind of managed, we know it's a problem, but we're taking care of it. It's okay. It's not killing us. We're not losing sleep over it. We're sorting it bit by bit, step by step, and it's not under our skin. Then we are more emotionally stable and we'll have more clarity of thought. And then we're fit to trade. And that is because the financial markets is a very triggering environment. I mean, there's volume and prices and people making money and losing money and all kinds of stuff. And we're so stimulated when we show up to trade that, if we are not emotionally volatile, we're going to get caught up in some trigger or the other. We're going to see a volume spike and the price moving, going to chase it. I mean, how many times have we all done that, Or then how about revenge trading? There's so many ways, over trading. There's so many things that we could get caught up in if we ourselves to begin with are not at our best strength. And we need all the strength we've got to overcome all those emotional triggers that the market provides. That's why one of the biggest pieces of risk management that we don't talk about enough, I believe, is you, the person, us, the trader. And that is before we begin to trade, before we decide, okay, I'm going to wake up and I'm going to go trade. Even after you wake up, you got to take your time, take a half hour, figure yourself out, have your coffee, go to the gym, do whatever you have to do, and assess yourself, self-awareness, and figure out, am I fit to trade today? And you got to do that before you trade. And here's a screenshot of a tweet I put out about a month ago. And I wrote down here, I'm not trading today, and good luck everybody out there. The reason on this day and most of this month was I was very distracted in January. I had friends over, family over. My brother came in from San Francisco. My grandparents came to town. My kids were home from school. Everyone was kind of home. It was house full and all kinds of stuff going around. And I was distracted. So I didn't trade most of the month, because I knew that I wanted to be with my family while there's the opportunity to do so, for those couple of weeks during January when everyone was here. And I kind of felt like, okay, should I trade? If I go and trade, I better be done quickly and then go back to my family. No, man, that's not the way to do it. Okay, just don't even do it to begin with. So this tweet right here is an example of basically just assessing yourself before you show up to trade and making sure that you are fit to trade. And this is a question you got to ask yourself, it's self-awareness. And I think this is really, really critical. Have I lost anybody yet? I feel like I'm talking to myself in this room. Is everybody here? Yes, no, thumbs up, good? Yes, okay, good. Very good, cool. I didn't see any movements. I'm like, wait a second, is everything stuck? Cool. All right, so here's one thing we don't talk about. Again, assess yourself before you begin to trade. And it's a big piece of risk management. Okay, really, really critical. Yeah, Shane, awesome. Yeah, tell yourself that. You got to tell yourself that. So here we go. Now, let's say you show up to trade. Let's say you've assessed yourself, you're good to go, and then you show up. You start watching the market, you do your pre-market thing, the market opens, and now you're involved. Well, your first thing is mental capital and the status of your mental capital. So after you're watching the market, after you take a trade, and maybe you take two, maybe you take three, the truth is, after your first trade, whether it was a success or a loss, the truth is you are no longer the same person you were before you took that first trade, because you have now used some mental capital, and now so your mental capital is slightly depleted. Now you have to be aware of that. And at what point is your mental capital depleted enough that you cannot make a clear decision anymore about taking a trade? So that's something you got to be aware of while you're trading, while you're making money and losing money, and it was green, but then you didn't take a profit, then you stopped out, then you revenged, all that stuff that we've all experienced. You got to be aware of your mental status so you don't do a lot of that stuff, basically destructive decisions. You got to know that, okay, now I'm quite tired and taking two trades, and not exactly hit my target, but I haven't made a lot of losses either. It's all good. Just walk away. You don't need to stress yourself out putting more risk in the market. The market's always going to be here. It'll be here tomorrow. It'll be here a month from now. It'll be here. I promise you. It'll always be here. Okay. So being aware of your mental capital status is really critical, just like watching your P&L capital, your account capital. But we just don't pay enough attention to ourselves. We think, okay, we'll get in, we'll hold it all day. That's the trade plan. But the truth is you're exhausted after 5 minutes of waiting and watching it. Okay, so if you're that kind of person, well, you got to know about yourself. So therefore, that style of trading may not be for you. So anyways, we'll get into that in a minute. But that mental capital, okay, again, something we don't talk about enough, really these are not things you can put a gauge on. It's more about self-awareness. It's not a number on a screen. So you really got to just kind of pay attention to yourself. This is where meditation comes in. The more you do that, I believe the more self-aware you become. And then you're able to be aware of yourself even in very stimulating environments like the financial market. So I think that's really important. The second point I've got here is that P&L. Now, there's this whole thing about, keep your P&L hidden when you trade. Let me tell you, at least in my little story, I've been able to elevate the size of my trading, as in take bigger profits, when I was able to finally get the P&L off the screen. That's when I was able to really size up my trading. Until that point, I couldn't. I tried taking heavier size, but I couldn't hold it for targets. I would just take it off because I'm watching the P&L. And I'm just taking 90% of the position off before it gets to the target. If I held it, it would have been a much bigger trade. Now, the truth is, once the P&L was off the screen, I was able to hold it. I didn't know what the P&L is doing. And therefore, I'm not getting emotionally triggered by it. And this is a problem we all struggle with. I've struggled with it a lot myself, I can tell you that. And the thing is, when the P&L is exposed and always there, right next to your indicators and everything, it is probably the most emotionally triggering thing to us traders, right there on our screen. And it is just poking us all the time. Happy, sad, happy, sad. It goes against us a little bit. We want to stop out, or we hold it because we've married the trade instead of realizing it's just a trade and we have to stop out. I mean, there's just so much that could go on, and we all get triggered different ways. But to put it simply, to have clarity of thought, you cannot be in an environment that is so emotionally triggering. So, well, basically minimize those emotional triggers. Get them off the screen. So P&L is one of them. You know what's another funny one I took off my screens recently? Moving averages. I basically took them all off. They just drive me nuts. And I was like, is it long? Is it short? Is it holding? Is it just enough? But that's one of the smaller ones. But that's very unique to me. But this whole P&L thing, now that affects us all. Every single one of us. So get it off the screen. Look at it after you're done with the trade. After you're out 80, 90% of your position, you've already stuck it at break even, for example, and you're pretty much done. Then take a look and you can reward yourself. Oh, look at that. That P&L worked out or it didn't, whatever. But while you're in the trade, it'll inspire you to make decisions that are really kind of destructive to trading. It's a hard one because it's, we're all here to try to make money. So it's a hard one to do, but I can tell you it's a breakthrough when you do it. Definitely do it. Every single one of you still have it on the screen. Take it off the screen and challenge yourself. For this 2-week period, I'm going to take it off the screen and see what happens. I'm serious. Try this. It was magic for me. When I figured this out, it was like a magic indicator appeared, which is what? There's an empty space on the screen where the P&L used to be. That's a magic indicator. Okay, we're all looking for that magic one. Here it is. There you go. I should have actually titled this Magic Indicator webinar. That would have been better. And this last one here, the dollar risk versus reward while we're trading. Now, the truth is, this is the one we do talk about quite a bit. You want that asymmetric risk to reward. When you enter a trade, it should offer you a 3-to-1 or a 5-to-1. 3-to-1 should be like a standard sort of thing. And so the truth is, if you are not entering 3-to-1 kind of trades, then let's say you're entering 1-to-1 kind of trades, that means you lose half your trades, you'll win half your trades, and 50% is pretty realistic. Even for us, even for the most experienced guys, 50% is very realistic trading win rate. And if you're just making 1-to-1 on the ones that win, well, the truth is you can't afford to make losers. And the truth about that is you don't know where the market's going to go after you enter. You just don't. That's the fact of it. We do our best to make our best assumptions and guesses and indicators line up. But once you enter the trade, you don't know where it's going to go. That's why you should only enter trades that give you an asymmetric risk to reward, a 3-to-1 or better. If it's not, then you should not be entering the trade, because you need to have the opportunity to lose some trades. And I'll show you some examples here, but you really need that opportunity. If you don't have the opportunity to lose trades, it's going to stress you out. You're just going to make bad decisions, and either way, it's not going to work out. It's just not. Day trading is not going to work for you. Okay, so this whole risk to reward thing is really critical. It is something we talk about a fair bit. I'm not going to get too much into position sizing here because we always talk about that. But it is a very big piece of risk management. Risk to reward. Do not enter trades that offer you an asymmetric risk to reward. I actually do that even in the world of investing, where I'm looking at a 5-to-1 risk to reward at a minimum, and then looking at the oil market or natural gas or whatever it is that I'm doing there. So asymmetric risk to reward, absolutely critical, must get it. So basically, to summarize this screen right here, this is when you show up to trade, you got to be aware of your mental capital. Make sure that if it's depleted to a point where you can't make clear-cut decisions, you should not be there anymore. And then the second one here, make sure P&L is off the screen. It's far too emotionally triggering. And when you do take a trade, make sure you're getting really seriously good asymmetric risk to reward. Anybody here still with me or lost or questions? Are we good? No thumbs up, nothing? Okay, good. Once again, I'm not talking to myself. Fantastic. I like that. Cool, man. Cool. Thank you. All right, let's move on. So another little bit about the trader, and stepping back a little bit at this point. We all have different personalities. And the truth is about finding a strategy, or I don't even like to use the word strategy, but finding a style that is sustainable for you and consistently profitable for you. That style should be a reflection of your personality. And some examples are, some people are more analytical and they like to absorb a lot of information and crunch it all and then make a decision about putting risk on the market or not. Some people are at the other end of the spectrum where they like to see the action momentum. They like to flow with the momentum, and they're able to get out when the momentum dies or stalls. And there's all kinds of in between. And some people, they only have that, what do you call, stamina for 15 minutes of being with the financial markets, and beyond that they're depleted. They just too stimulated, and they need to walk away. So now their trading style has to incorporate that. It has to be a reflection of your personality. That doesn't mean, don't listen to everybody else who's got good styles and are successful. I say get with all the experienced traders around you here in BBT. There's so much experience here. It's great. And learn a lot of the styles and the reasons why those rules exist in their trade book, and play around with them. And also then, as you're playing with them, as you're trying different things, it's really important to gauge whether you're fighting your instincts to follow the rules, or is it coming naturally to you? And this is a great big 80-20 thing, in my opinion. You should have a trade book that is not fighting your instincts, but rather taking advantage of your instincts. Then it's sustainable. Then it's actually fun. Then you're not stressed out for an hour before the market even opens. I used to be stressed out for hours before the market even opened. So, it's important that your style is not a battle for you. It's important that it's a pace at which you function. It's important it's got all the indicators that come out and look at you, rather than you're trying to decipher it. You can't make sense of it. It's important that they're easy to your eyes. I was just telling you, I don't like moving averages. They mess with me. I don't understand why they're there. But I can draw horizontal lines on charts, and I understand why they're there. So I'm happy to trade off of that. Now, those lines are easy for me to decipher and figure out. So that's a part of my trade book. And moving averages are out, for example. Another example is I know that beyond the first 15 or 20 minutes, I'm quite depleted when I'm trading. I'm actually no longer the same person I was at the open. I'm exhausted and tired, so I don't normally sit around that long and trade. I usually shut it all down. So Barracuda, I keep VWAP. So far, that's still there, just that one on the 1 minute chart, and that's the only moving thing on my chart. So it's important that you're not fighting your instincts. And I can't tell you about your instincts. This is a matter of self-awareness. Now, we're all grown-ups here, so you all have some self-awareness in you. We're not 15-year-old teenagers running around on the streets causing trouble. Ideally, we're not. But so it takes a lot of introspection, a little bit of taking time now to sit back and look at yourself and take a hard look at yourself and identify your personality traits. Put all those traits on the table and see what you can take advantage of here rather than fight them. And then when you have destructive personality traits, so you get triggered on certain things that may happen in the market, like you see a big level 2 thing and it triggers you, well, that's when you need rules in place to tell you that, okay, when you see this now, you do not make that decision. Look for another confirmation as well. And that's how you build your trade book. So really your trade book is a reflection of your personality. And when it really is a reflection of your personality, it's really original. It really is. And it's something that comes quite naturally to you. And then I can't even tell you how much fun trading becomes. It really is. I love it. I get excited about trading. It's kind of hard for me to say, no, I don't want to trade today, or I shouldn't trade today. That's where I struggle. But it should get to that point where it's fun, because the whole process is just aligned with your instincts, your natural instincts. That's your trade book. And that's the trade book that will be sustainable for you. And I don't even call it a trade book, I call it a trading style. And that's another piece of risk management right there. Because again, if you're fighting it, you're going to make a mess, taking on way too much risk. So you can see now the majority of the risk that we've talked about here is actually all in here. It's in us, and it's in our head, it's in our emotions, it's all over the place. There's all the dollar risk and stuff, and we talk about that a lot, but this is the other side of it, the more psychological side of it that we should pay more attention to. Anybody got any questions so far before we move on and I bend our brains a little more? Bend my own brain. Good, yes, no? Gosh, this is a quiet crowd today. No? All right. Cool. All right, let's move on. Let's get some fun into this. So again, risk management, it's a lot more than just position sizing, right? We enter, we have a stop loss. How many dollars do we risk? That's position sizing. Risk management, once you have a good grasp of it, is a lot more than position sizing. So I'd like to draw your attention to this. really important. All that personality stuff, self-assessment, self-awareness, that's the 80%. As in, pay attention to that stuff, because 80% of your results will come from that, really. And that has been my experience, and even with the mentees I've got. It always comes down to this sort of thing. It's not so much position sizing. So hope that makes sense. And here's another one. Showed up on January 29th to trade, and I said I had a look at the market. I didn't like the look of any setups, so I didn't trade, and I just walked away. And yeah, risk management. You know what? Here's another trick. Little trick I use. I've shared it before, I think. I like to put everything out there on Twitter, well, on X these days. Why? Because, I'm holding the whole Twitter community accountable. I mean, making myself accountable to the community. So if I say I'm going to do something and then I do something else, well, then there's no integrity, right? So I'm using that. I'm kind of using my own ego against myself. So there you go. Risk management right there. I always have been doing this. This is actually one of the best things I've done. It's elevated my trading because I have a decision I've made and I need to be accountable to stick to it. So I'm taking advantage of all you folks out there. There you go. That's funny. You can use that. That's powerful. So do that. All right. A little bit of risk management and trading. So let's get into trading. So let's say you've assessed yourself. You've showed up to trade. You know you're good to trade. You have clarity of thought. You're watching the market, waiting for your setup, all that good stuff. So here's the thing. On Meta, on this day, before the market opened, it just crashed down. Remember, this was the day when the news came out. When was the last week or something, when inflation numbers were higher than expected, I think, or something. So the point is, my whole plan, based on everything I'd seen, was that it's coming down. I don't see that kind of news lasting. It's going to find a bottom somewhere. Buyers are going to want this. It's cheaper now than it was, yesterday. And where should we be finding some support? Well, right about in this area, right about where it looks like it wants to open. So basically, the plan of the day was look for buyers to come in. Just looking at a long thesis. That's all. Here's the 1 minute as it opened. This is the opening price, this green line here. It was a bit of an indecision right at the opening price, but it looked strong after indecision. And here's the thing about risk management with indecision. When there's indecision, what you want is for it to make a decision, right? So when it makes a decision, it's pretty obvious when it does. It either goes up or it goes down. It goes away from there. When it doesn't make a decision, it just sits right in that area. The way I saw this, it's making a decision. It's going up, and it's strong off of the opening price. I never even came back to touch it. Now, the opening price, in my view, is quite an important level, so I'm using that. So I got my entry there. Risk management was that it's strong off of opening price. So stop loss entry was there, and stop loss was right at the opening price. If it came down there, I'd be out. And then it was strong above VWAP. It went down a bit, found more buyers, and went up and started breaking that 1 minute high. Fantastic. So as it did that, I can now use VWAP as my risk management. So I added in and moved my stop in tighter. Risk management right there. And I'm in the trade. Watching momentum. 460 was a big round number, so I got a lot of partials right there. Everything else beyond that was pretty much a bonus. I was hoping to get up to 464, about halfway into the range. But no big deal. Got what you got, right? But the whole point here is risk management. So from the very beginning, there was never going to be a short, in my opinion, because it's cheap now. After there's a big crash, well, people want to buy it. So I'm just waiting for that. So that's that market psychology side of things. And then the price action to confirm that. And the more confirmation you get, the more you can scale in and tighten up your stops and get into the move. So that's how I execute on risk management as far as actually being in the markets and trading is concerned. So that turned out to be a little over $5,000 right there. So that's that. What do you guys think of that? Any questions on how this risk management kind of goes? Are we good so far? Yeah. How do you use volume? Helen, yeah, so volume is a good one. In this particular chart right here, volume is a great big mess, right? So basically, I'm looking for a good sort of volume. Now, this is Meta. It always has this kind of volume right at the open. And when you have something that moves and then let's say it's directional, right? Then you're looking for when does it stop? When's the move done? Well, that's when you want to see a volume anomaly, ideally. Now, this didn't actually give us any of that. So as far as volume was going, this is actually quite a dangerous stock to trade. I actually tell this to my mentees quite a bit. Watch out with Meta and Microsoft, Google, and Apple. Those four, generally speaking, the volume looks like this. After the first minute, the rest of the day is like 10% of the first minute. So this is not a good example of how to use volume on the trade. I was watching more on basically where's the candle going? What levels is it claiming and holding? That aligns with my idea here that it's cheap. That was the whole idea. So I hope that answers that. But yeah, on volume, there's a whole different game, and this is not a good example of volume. And I'm not looking at volume here. This is not even relevant. I'm trading here. It's just when I hit the hotkeys, it takes my trades over here. So there we go. Any other questions, anybody, on this one? What is Meta? Oh, that's just the name of the options contract. It's a call for 465 strike price. So it's just on the options thing. Cool. How'd you determine the exit? Yeah, good one. So the exit, now 460 was on my mind. I had seen some orders there on the level 2, and it's a great big round number. So I already had that in mind. So 460 was it. And then I was trying to hold for hopefully it keeps running up. The thing is, it's really struggled. Like every time it went up, it popped down. Then it made a decision. And then this thing was slow to go. And so I was just like 10% every time, just getting out. But after about this area right here, I was already out, let's say 80, 90% of my position. So all of this was just bonus. It was just bonus. If I knew this was going to be the top, I would have held for the top. I didn't know. You don't know what the market does, right? I mean, we have no clue. We just try to take the best setups we can take. So that is really, you got to minimize your risk by taking partials. Now, when you're trading the open, you take partials when the momentum is going against you. It's momentum trading. But that's the way to do it. And I like to use round numbers and orders on the level 2. Stop loss. Yeah, stop loss. I just have it in my head right here on the 1 minute chart. So if the 1 minute candle goes to that stop, I just stop. I hit the button and it stops me out over here. That's it. I'm out of it. It's mental usually because it's the open. It opens pretty fast. If I'm still in it a little later on, I'll stick it at break even and go play guitar or do something, something like that. Yeah, cool. Any questions on this? And move on to the next one. All good. Cool. All right. Tesla. So on this one, check it out. So risk management, everything here, I'm just trying to focus in on the risk management aspect of it. On this day, it opened here, went down, went up, and it closed not too far off where it opened from. And it was basically an indecision kind of day. It made quite a big range. Huh? And then after the close, it was below the close. And then in the pre-market, next day, it was quite strong above the close. Okay, so I'm bouncing off the previous day's, probably previous day's high, I think. Anyways, point is, it's strong above the closing price in the pre-market and it wants to go. And then it bounces off the pre-market, in the pre-market off of the previous day's close. That's that 8 o'clock candle. And so this I'm interested in a long from the previous day's close because, well, generally it's telling me that it's strong, but also it's telling me that it's struggling up here at the previous day's high. So my idea, just watching the action here in the pre-market, risk management-wise, the most likely thing that it'll do, most likely, again, risk management, right? The most likely thing that it will do is stay in this range right here. We have previous day's close and the previous day's high. And so that's it. I'm thinking this is what it wants to do. Until I'm proven wrong, this is what it's doing. And that's it. So take a look. It opens here. Sure enough, bounces right off of yesterday's close, the previous day's close. Now look, this one I still have moving averages and stuff. This is an older screenshot. But anyways, bounces off the close, previous day's close, reclaim the opening price, goes through VWAP, okay, and hits its head on the previous day's high. That one right there. And here's where the fun starts. This is where it proves me wrong. It goes above previous day's high, basically breaks out and it holds. As it starts holding there, now what I'm thinking, my whole idea that it's going to stay within yesterday's range here, that's no longer valid. Why is it no longer valid? Well, because it broke out. And just look where it is, right? And it's bouncing off it. It's holding. So now this gives me conviction to start entering, and that's me getting involved, starting to scale in my position as it's hanging out here just above yesterday's high. And then the risk management is right below yesterday's high, because now you have to understand the whole thesis is that it's breaking out of yesterday's range. Therefore, risk management is, if it comes back into yesterday's range, you stop out. Straight up and simple. There's no two ways about it. And then once you scale in, you're in it and it goes. And that worked out quite nicely. That was, just over about $6,000. So there you go. Risk management right there. So again, here's the point. Focus on risk management. Once you nail down risk management, the profits will take care of themselves. I learned this from Andrew, and I'm trying to nail it in here for everybody because it is so powerful. That's really it. Risk management right there. Does anyone have questions on this one? Slippage in the time. Yeah, there is slippage. There is. And you got to account for that. If you're trading something like Netflix, massive spread, you're trading options, you're going to get a spread. So you account for that. You expect it. It's a negative sum game. Listen, to get into a position, you pay commissions, right? And then you're paying the bid or the ask. So you're getting slippage, basically. You're always, just to enter the market, you're losing money. I mean, you got to pay subscription to DOS. You got all this stuff before you have the opportunity to enter or even make money. So you got to account for all that. It's part of doing business. And I think it's actually a lot cheaper than a regular business. So you got to, you can't really think too much about the commissions and stuff. It's important you focus in on the impactful stuff, right? The 80-20 stuff, which is risk management on the trade. Where do you get in? Where do you stop out? Do you get asymmetric risk to reward? And in this case, I'm entering around here, stop loss right below, and it's going up to about 194. That's my next level. So it's asymmetric risk to reward. Look at that. Got in and held pretty much up to the level. So that's risk to reward stuff. Does that make sense? You got to have that. The next one I'm going to show you is going to show you even more about that. And that one's pretty nuts. So any questions on this stuff, guys? Yeah, Atif, how do you ensure it's not a false breakout? Well, check it out. Breakout, it comes down here and starts bouncing off the level. That's pretty much the best thing you can get. And look at this one with low volume down to the level. And so it's going down with low volume. That gives me a fair bit of conviction that this thing really is holding on the upside. There are buyers here more than there are sellers. And this is a bullish sign. Basically breaks out of a significant level. You can see it just reversed right here. It reversed again here. And now it's going up. Okay. It's a significant level. It's a powerful breakout. So that makes sense to me. That's why I would get it. Hey, Andrew. Hey, I'm just regurgitating everything I learned from you, man. That's about it. So, yeah, there's risk to reward. Cool. Has anyone got any questions before we go into the next one and I really embarrass myself? "30-minute chart, how many days do you look?" Yeah, good one, Helen. Well, I zoom out as far as I need to for it to make sense to my eyes. Really, I kind of if you watch me trade before the market opens, I'm zooming in, zooming out. It'll drive most people crazy. But I just zoom out until, okay, now I see a range. I see a level. Cool. I just mark that level. And then let's see if it comes to that, I will use that level. That's basically how I do it. Where would I put my stop? Is right below the level. The whole thesis of this trade is that it's holding above yesterday's high. So my stop loss is right below yesterday's high. Give it a few cents of room, a little bit. That's about it. Kind of eyeball it a little, and off it goes. Cool. So what's the question here? How do you set the level precisely? Do you know support level, wicks? Okay, yeah. Now here's the thing about levels. They're areas, okay? Absolutely critical thing to understand. And that drove me nuts for a long time. They're areas. And so the only way that I bring in a little bit of precision is I like to use round numbers. That makes it a little more precise, but you still should give it more room. So when I'm drawing levels, I use round numbers. I round it off to the closest round number. These levels that are auto-drawn, they are precisely the levels that the stock bounced off of. Yesterday's high, yesterday's low, yesterday's close, all that stuff. So yeah, that's how I use the levels. Cool. Speak of some changing risks based on time of day. Stop sweater. Oh, okay. Yeah, time of day. Now, here's the thing. Remember we talked about personality and how personality is important with risk management, and your trade book should be a reflection of your personality. Well, now that depends on, well, if your personality is suited to trading that time of the day, then you really get intimate with that time of the day, and you'll get exposure, you get experience, and you get a feel for how much room you need to give it. As compared to right at the open, how much room would you give it? So yes, it is very different and it's very specific. And then volatility actually drops later on in the day. So things move slower. But in a funny way, on a 1 minute chart, it looks more choppy. So you think, wait a sec, that's more volatile, right? So all of that's down to perception. And again, it's all down to your trading style. Me personally, I can't even talk much about trading in the middle of the day because I don't do that. I have like no credibility on the subject. I'm hardly ever there more than 15 minutes after the open. So I can't really tell you much about trading in the middle of the day. The only way that I have done it in the past is looking at bigger time frames, like trends on a 60-minute, almost like a swing trade mentality. And it's holding a particular moving average, and you're just using that, a trailing stop on a moving average. That's the only thing that actually makes a little sense to me in the middle of the day. But I don't know why you would trade the middle of the day when you have a lot more fun at the open. So that's how I would do it. That's how I do it. So, cool. Everyone still here? Still with me? Okay with this one? Should I go on to the next one? Oh, wait. We got a question here. Choose out of the money strike prices over, is it cheaper premium? Well, no, not really. It has nothing to do with that. I just choose the strike price that is my target. So, for example, if my target is 194, I'd like to buy the 194 call options. Turns out the closest one was 195. Okay, so I got 195 and I go along with that. That's it. And the whole reason for that is to take advantage of the gamma. So gamma basically expands the options price as it gets close to its strike price. That's about it. Just trying to take advantage of options pricing, but it's not a significant thing. It's still important to pay attention to the price action. And if it's not going to 195, then don't hold it to 195. If it's getting off at 194, then get off. That's it. It's, no matter what strike price you pick for whatever reason, in the end, you're still executing on the stock, on the price action. Cool? All right, cool. Yeah, here we're going to have some fun with this. Check this out. Okay, now the whole point of these next two slides is risk to reward. All right, check this out. Tesla did all this stuff. I took 3 attempts on Tesla. Long, stopped out, long, stopped out, long, stopped out. Okay, 3 trades, stopped out every time. That was close to a $12,000 loss in total over 3 trades. Okay, and now look at the next slide. Meta took 1 trade, $20,000. So you see, risk to reward. This is what I was talking about earlier. You have to have the opportunity to stop out. It really is amazing when you got to take trades with high risk to reward. And that works on both sides. As in, you should stop out when it gets to your stop. Otherwise, you're taking way too much risk and you're being emotional. You're holding past your stop, which is no good. You're not going to succeed doing that. And the other side is when you get into a trade, hold for your target unless it tells you that it's not going to your target. And that's really, really, really critical. This is a hard one because, we always, a lot of us, we get out too early. And that's a struggle. We want to take the money, put it in our pockets and go. But when you do have to stop out, you're going to end up losing money because you're not getting good risk to reward if you're just getting off too early. So there's a balancing act to be done, to be played over there when you are trading. So again, the whole point of these last 2 slides is risk to reward. Look, 3 trades was the $12,000 loss and another one on Amazon. So this is 4 trades made losses, but then I more than made up for it on 1 trade. That's the power of risk to reward. And to tell you this one, the risk was, it's holding above this green line here, which is yesterday's open price. So I got involved right above it, stop loss right below it. And the further it held, and I was convinced it's holding above the line, I added in more. The stop loss was right there, scaled into full risk, full size, and holding for the target, which I had 470 in mind, basically held right up to there. That's it. That was the whole trade. So that's risk to reward. You can see how tight the risk to reward worked out in this case with scaling up to my maximum risk tolerance, which actually I did also on these trades. These trades were risking $2,000 to $4,000 per trade, and no matter how many dollars you risk, you still got to have risk to reward working in your favor. And the only way to do that is to do that, just by literally risk to reward in your favor. You've got to do that. Otherwise, this is a losing sum game, and it's not going to work. So, anybody have questions on this sort of thing? Don't kid me, Andrew. I see you take $50,000 trades. I feel like a little puppy right here. I want to take bigger trades, man. Slowly. Can't just go too big too fast. You'll hurt your account. You hurt your head. So, cool. Anybody got any questions? Good? All right. Wow, look at that. Last time I did the presentation, it took 2 hours. 20, yeah. Comfort zone is one thing. That's a good thing. So stick with it until you're confident. Now, here's the thing about sizing up. In my experience, sizing up is interesting. A lot of people think about, okay, now I take bigger risk per trade. Well, you know what? I found that learning how to scale into a trade, or even adding in after taking partials, that's a better way to size up. Learn it that way. That's more sustainable. And you actually manage your risk. You actually don't necessarily put more dollar risk in a trade when you're adding in and you're tightening your stop. So it's actually a better way to size up. And that's how I've kind of learned it. So do it that way. And then maybe slowly increase your risk that way, rather than just go, jump your risk on one fine day. So I think it's smoother. How do you deal with a mental capacity hit? Hey, JH, great question. And this brings us back to what we talked about 30 minutes ago. This whole P&L is not on the screen. It used to be when I traded, let's say 6 months ago, perhaps. But this is off to the side. Only when I take a screenshot do I slide it into the screen and take a screenshot. So realistically, especially when I've made 1 or 2 or 3 losses, I know I've made a few $1,000s in losses. I don't want to know the number. All I'm doing is just focusing on the next trade. Now, when I have a green trade up front, I generally tend to look at the P&L and realize, okay, you know what? I'm pretty good for the day. I don't think I need to trade much more. That's the way I do it. But the moment I start making red trades, the worst thing for me to do is to open my P&L and then look for another trade. That's dangerous, because that's called revenge trading, and then over trading, and then all that stuff. We all know that cycle, right? And that is terrible. That's how we blow everything up. So please don't do that. P&L off the screen as much as you can. My way is, when I'm red, I don't look at it. Sometimes I quite literally just hit the button on the computer, just let it just shut itself down, just brutally shut it down and go walk away. I gotta get out of the house. Max loss, Barracuda. Yeah, here's a fun thing about max loss. We always talk about that. You should have that, per day or per trade or something of that sort. Nowadays, my max loss is mental capital, because I have found that that's where the majority of my results and losses are. When I'm not clear-headed, that's when I'm making losses. And so when my mental capital is depleted, that's it. I'm really not there much more. And usually these days it's like 20, 30 minutes. I'm not really there more than 30 minutes into the open. I mean, it's rare, like on this day. So I kind of do it that way nowadays, but you got to trust yourself if you want to do that. You have to earn your own trust, and that's hard, man. I've been trading for 5 years, almost 5 years now, and it's only now that I'm starting to trust myself, that I know when to stop. I know when I'm depleted mentally and emotionally, and it's irrelevant on what the P&L is telling me. It truly is. I could be up $20,000 and still have energy to trade, and I've taken trades beyond that. I've done that too. So it's a mental self-awareness thing, and it's the best place to be once you get there, once you earn your own trust. But you got to earn it. You got to earn it from yourself, from your own subconscious. So again, I'd suggest meditation, introspection, all that good stuff. That is kind of where you build these sorts of skills that help in trading. Do you still journal wins, losses? Yeah, I you know what? I use a journaling software, which I haven't logged into in like 3 months, and I don't even know if it's still importing my trades. I should do it right. So that it does that, and it has all the statistics and everything in there. The way I do it practically every day is I take screenshots like this, and I stick it up on Twitter or share it in the chat room. and write 1 or 2 comments on it. Yeah, that trade worked out. That one was no good. That was FOMO. That one, that's about it. That's kind of how I do it now. Fairly simple, because to me, it's not so much anymore about the statistics and the numbers. It's more about how did I perform? Did I keep my trust, or did I betray myself? And those are the real questions. I don't need pieces of paper to write down to tell me that. That's, I know that already. So that's the way I evaluate myself and journal myself. And what you see on Twitter and all is, what all I have on the screen. I just put it out there. So that's kind of my process these days. Cool. So what else do we have for questions so far? All right, good. So I want to move on into a little thing, again, back to the whole bigger idea, risk management. Even in my last webinar, I think I put this screenshot up there. I read this book, The Art of War. We all know it. Read it about a year ago. Really good stuff. So in this book, there was this one page where it talks about you got to secure yourself against defeat, and that lies in your own hands. And then the opportunity to defeat the enemy was provided by the enemy. That's the art of war. Yeah, brutal violence. I get it. But it's very applicable to the market and what we're trying to do here as day traders. So remember, secure yourself against defeat. That is in your own hands. Risk management, like we were discussing, it's all about self-awareness of your personality. Are you fit to trade today? Are you emotionally stable when you showed up? Are you hungover? Did you not sleep enough? Then you should not be trading. So don't even show up. That's risk management at the bigger level. Really important. You're securing yourself against defeat by doing that. And then when you are there, paying attention to your mental capital as you are trading and keeping your P&L off the screen as you are trading. And then when you take trades, make sure you're getting asymmetric risk to reward. All of these things is a matter of really protecting yourself from defeat. And then the profits will take care of themselves. That opportunity will be there. This is the financial market. It's a gold mine. I just love how many opportunities there are every day. It's such a party, man. So really, risk management, either your greatest ally or your most formidable foe. And it truly is all in your own hands, truly. There's nothing to blame. There's no market to blame or no strategy to blame or the indicator was faulty or nothing. It's not, none of that stuff. The biggest, most impactful stuff lies in your hands, which is your own self-assessment, managing yourself. And the technical stuff, well, you know the technical stuff. Volume, candles, moving averages, it's not a whole lot. But you got to manage yourself. That's the bigger picture of it. And then you earn your trust, and then you go into other stuff. You realize when you shouldn't trade, when you should trade, when it's going to be a $50,000 day, or it's a day when you lose 10,000, and you're like, okay, no big deal, forget about it. Once you earn your own trust, you get there. But you got to realize up front now, it's in your hands to protect yourself from defeat. Earn your trust, do it often enough to earn your trust. And then you can really size up and be consistent. And like I said earlier, when day trading works for you, when you get it to work for you, it provides a fantastic way to live because you have time freedom and financial freedom. Do whatever you want with your life. So, that's really it. That's where it is, in my opinion. That's the most important part of day trading. The whole 80-20, singular 80-20 point. Risk management. Absolutely the most important thing. And having said that, I hope you guys got something out of this. And that's all I really have to share with you today. And you can reach out to me on Twitter or Instagram or email. Twitter is probably the easiest, fastest, where I can respond fastest. If you're interested in mentoring, reach out to me. I do a lot of that these days. And please let me know if you show up in Dubai. It'd be good to meet other traders. And having said all that, any questions, guys, let me know. I'm still here. Yeah, Vancouver. Hey, there is a 5% chance I may not make it to Vancouver. It's just 5%. I'm not counting on it. There's a 95% chance I'll be there. I'll be booking my flights at the end of this month. So another week. Okay, just another week. It's just like bugging me. I wanna really go. Yeah, Sarah, risk management. And risk management really on the bigger stuff, the personality stuff. That's what we don't talk about enough, and I think we need to. That's the psychology side of it, right? Are you fit to trade? Does your trading style match your personality? Are you fighting yourself? Have you earned your own trust? Risk to reward, all those sorts of things. Yeah. Cool. Yeah, earn your trust. Watch yourself. And to build self-awareness, again, meditation is one of those things I do, but realistically, there's so many ways to do it. And you got to practice this outside of trading. Get out there in the world, just be aware of yourself. And there's a million things. I mean, connect with me outside of this webinar, and I'm happy to share other things that I do. But yeah, it's all in you. Yeah, thank you, Barracuda. I'm glad you guys got something out of this, and I'm glad I didn't keep you here for 2 hours. It's been 1 hour and 5 minutes, so whew, I was stressed about that. Cool. Switch back to the quote. Yeah, sure. Where is it? There it is. Page 48 in The Art of War. Great book. I'll always keep it on my desk. Yeah, man. I'm glad you like the one-on-one stuff. It's cool. I enjoy that too, because you really dig in and get to know people, because you got to dig into personality traits, and then you end up really making friends with people. That's the best. It's so great. It's really rewarding like that, and especially when your mentees make progress and break barriers. That's great. Awesome, man. That's great to hear. Great to hear. Cool. All right. Good. So yeah, hey, Mike, I think we're done here. We can stop the recording. Thanks, guys, for hanging out. This was awesome. Always love the opportunity to be out here and talk with you all. So great. And thanks for sticking around and hanging out. Love it. Yeah. Hey, Mike, just let me know when the recording's good and done. I'll keep it all open till then. Oh, my throat hurts. Oh. Yeah, sure, guys. It's a pleasure. I love this stuff. I could talk day trading all day. It's actually not healthy. Yeah, thanks, Tom. Yeah, so there it is. Yeah, if you want to contact me, that's where you can find me.